Hello everyone, I'm Wendy Everett, the ABU's Director of News, and welcome to the Deep Brief, an initiative from the ABU News Department. Now look, the idea is to engage the best experts to give deep background on a current affairs topic so journalists and editors get a strong understanding of the subject. So we're thrilled today to welcome Dr. Hamid, Rashid, Chief of the Global Economic Monitoring Branch of the UN Department of Economic and Social Affairs, UNDESA. His topic, navigating the financial and economic uncertainties of the pandemic. It's a subject suggested at Asia Vision's January Editors-in-Chief meeting, and we are thrilled to welcome journalists and producers who've registered from at least 22 countries, from Vanuatu, Fiji, Solomon Islands in the Pacific, through Asia, South Asia and Central Asia to Europe. We hope you all get a deep understanding of the issue and some great story ideas as well. Thank you, Dr. Rashid, for joining us so late in the evening in New York. Here in Asia, it's a bit early for many ABU members. So for those who couldn't make it and for interested colleagues, this forum is being recorded and will be available on YouTube and on the Asia Vision website. It's now my pleasure to hand over to the moderator for today, Senior Editor of the ABU News Department, Rashid.
Thank you, Wendy, and welcome to everyone. It's a great pleasure to have you for the first official deep brief of this year. I'll just introduce Dr. Hamid Rashid briefly. As Wendy said, he is the Chief of the Global Economic Monitoring Branch of the United Nations Department of Economic and Social Affairs Unit, and he leads the writing team for the World Economic Situation and Prospects Report, which we'll be going through in detail today. Now he's an expert in the field, and you've all seen his bio in the little brief that we have sent you, so I would spare from going into more details, but I'll just give you a bit of ground rules of how the session is going to go. We'll first hear the presentation from Dr. Rashid, and then as he gives the presentation, if you have any questions, you can note it down or write it in the chat. Afterwards, we will open up for questions and answers, and we'll have a little discussion. So you can raise your hand and we will enable your mics and audios, or if you want us to relay the question, you can also write it down in the chat. We'll have the presentation for around 30 minutes, and then we'll go for another 45 minutes or so for Q&As, and we'll wrap it up then. So I hand over the floor for Dr. Rashid, who has so graciously agreed to come in this late at New York time. So Dr. Rashid, thank you, and I give the floor to you.
Thank you, Hamid, and colleagues. Good evening from New York. Good morning, good afternoon, or wherever you are. It's my pleasure to join from New York, and my presentation will be based on our annual flagship report, the World Economic Situation and Prospects. And I'll probably spend about 15 slides to show where we stand, the global economic prospects in the near term, and then we'll open up for questions and Q&A. Let me share the slides with you. Okay. Here you go. Okay, all right. So as we can see that we started 2022, there's still a lot of uncertainties about the global economy. 2021, by historical standard, was a good recovery. If you just look at the GDP numbers, it was the fastest growth in the last 45 years. Last time we saw global economy growing by more than 5% was in 1976. But hold your breath a little bit. It's not all good news, because most of the recovery of the growth was recovering the lost ground, because we had also the worst contraction in history for the last 75 years, and since the Great Depression. World economy contracted by 3.4% in 2020. Just to put that into perspective, world economy shrank by only 1.3% during the global financial crisis in 2009. When we talk about the global financial crisis, we remember a lot of turmoil just about 12 years ago. And at that time, there was a major shock to the global economy, and yet it was about 1.3% contraction. So compared to that, this is almost 3 times larger shock the world economy experienced in 2020. And from that shock, we jumped back 5.5%. In economics, we call it mostly driven by base effects. This is basically households were not spending, businesses were not investing, all the pent-up demand for consumption and investment they picked in 2021 as we had vaccinations and we had some reopening of the economies, and we saw growth coming back, reaching 5.5%. Going forward, obviously, we won't expect that growth rate to continue, although ideally we needed that rate of growth for the near term to fully recover from what we lost in 2020. But we'd expect, according to our model, we run some model-based forecasts. We expect the economy to grow, world economy to grow by 4% this year in 2022 and 3.5% in 2023. And this is sort of based on certain assumptions that we make. For any model, we need assumptions. Of course, one assumption is that the latest variant of the virus that is waning right now, and we will not see further outbreaks and major outbreaks in major regions of the world. So Omicron would not be a long-term thing going forward. And also would expect some kind of easing of the supply side constraints. Globally, now the fear is of rising inflation, and many countries are on the verge of experiencing inflation for the first time in 20 years, 30 years time. So this inflationary concern is driven partly by supply side constraints and supply chain breakdowns in some cases. And so this is we expect the inflation to moderate in 2022. So we won't see major policy shifts. That's also our assumption. So based on that, what is the main takeaway from the crisis? The pandemic that we experienced in the last 2 years. We are not completely out of the woods, but still we are seeing some light at the end of the tunnel. And what we are experiencing in terms of a longer-term effect of this pandemic is rising inequalities, both within countries and across countries. And I'll explain in a bit why this is important. Story of inequality is intrinsically linked to a story of poverty. We saw massive spike in poverty globally in 2020, despite significant interventions from governments, on the fiscal side, and monetary interventions from the monetary authorities, from central banks. But poverty spiked. People at the bottom rung of the societies, they fell below the poverty line. Still, as of today in 2022, we'd expect 64 million more people living in absolute poverty, extreme poverty, relative to what we had projected in the past, relative to 2019. So 64 million more people are added to the poverty, the group of people living in extreme poverty. And this is also almost mirrors the fact that unequal access to vaccine has played a very important role in this story of the pandemic. Vaccination is still almost 10% or so for many of the least developed countries, and some of this group of countries that are still not anywhere close to having herd immunity. So there's a lot of vulnerability there as well. And in terms of inequality between countries, unlike the global financial crisis, where we saw advanced economies, especially economies in Europe, were hardest hit by the global financial crisis. This time, although we didn't see a major pandemic outbreak except for a few countries like Brazil and India, but overall, the economic hit was much harder than the pandemic and the health-related shocks to many developing countries. And the recovery, while Europe and North America and China, they're recovering very fast, many of the developing countries will not recover to their output that they had in 2019. So they're still below their 2019 GDP level. And that is roughly about 1/5 of the countries, developing countries, 20% of them would be below their 2019 level of GDP still in 2023. And that is also within those countries and globally also, the bottom 40% of the world population received a much larger shock. Their income fell by about 6.7% compared to 2019, while the bottom top 40% didn't have that kind of contraction in income. So this is the poverty number. Like we in 2019, we had about 812 million people in absolute poverty. It spiked to 897 million in 2020. It came down a little bit to 889 million, but still relative to 2019, it's 64 million more people in extreme poverty. So what we see is that, in terms of GDP per capita, GDP per capita in the developed economies, they will mostly recover. If you look at the developed economies are at the dark green, they would mostly recover the entire GDP per capita by 2023, almost all of them. But if you look at the teal color or the beige color, the developing economies, their GDP per capita will still be about 2.5% less than what they had in relative to what we projected in 2020 before the 2019 before the pandemic. So this is the projection versus what we are seeing right now. So still a gap, a persistent gap, and we expect that gap to continue going forward. So the story of inequality and poverty is linked to job losses. Globally, job losses were significant, 137 million fewer jobs we have compared to what we had before the pandemic. And there's a paradox there as well. If you look at the developed countries, now it's not the shortfall of jobs. There are a lot of jobs available, but there are not enough people taking up those jobs. For various reasons, people have left the labor force. They don't want to come back. They're taking early retirement. We see what's happening in Canada right now and other places. And on the other hand, in the developing countries, we have not been able to create enough jobs throughout the pandemic. And that is a paradox, because we see in one part of the world, shortage of labor, and other part of the world, shortage of jobs. And add to that problem challenge is that we have food prices are rising in many cases, in many countries, and that is threatening food security for the bottom 40% of the population or bottom 20% of the population. And some of the commodity exporting economies are doing better among the developing countries, because the prices of commodities have recovered quite a bit. Oil prices now over $90. So even in the last 6 weeks, we have seen oil prices to increase by almost 50%. But the small island developing states, SIDS, they are still remain very depressed, because many of these countries are very tourism dependent, and tourism dependent economies have not recovered at the same pace as the commodity exporters or other more advanced economies. So the story of recovery is very uneven, and even those who are recovering, it's almost like one step forward, 2 steps backward. So there are it's a slippery slope for many countries. So this is the vaccination rates I talked about. If you look at for the least developed countries, we still have a very low vaccination rate, number of doses per 100 people, still around 25 and way below the global average of about 100 doses per 100 people. So I'll spend next few slides to show some of the regional stories, especially South Asia, East Asia, and West Asia, and then I'll go back to the policy messages that are critical. The title of my slide was "The Bumpy Road Ahead." So how is it bumpy? That's what I would explain in my last few slides. East Asia, obviously led by China, that did very well in terms of recovery. There's, if you look at the orange lines, this is the only region in the world that didn't go into the negative territory in 2020. So they still maintain positive growth rate in 2020, just about 1% growth. And in 2021, they achieved 6.7% average growth rate. So East Asia's contraction is a much shallower contraction, and they recovered better than other regions of the world. And we expect in this year, the region to grow by about 4.9%. South Asia's story is different compared to East Asia, where you see contraction is about much deeper, negative 4.7% in 2020, and 7.4% we estimated the region grew by 7.4% in 2021, and we expect growth to moderate to about 5.9%. And these are all, East Asia's case. Of course, the strong fiscal stimulus, policy stimulus played a very important role, and external demand was very strong. We saw the trade recovered very quickly, exports recovered very quickly for most of the East Asian economies. In case of South Asia, story is different. Definitely, we see a momentum gaining as infection has been contained, and remittance flows have increased, and that has supported the recovery to a large extent. But in South Asia compared to East Asia, the monetary space and fiscal policy space is much more constrained. So we won't see much more stimulus coming forward, and that means that the growth, sustaining the growth rate with some kind of stimulus would be much more difficult, much more constrained for South Asia. And then if you look at the two regions, there are also concerns about rising debt for many of those countries, debt distress, and sometimes there's always a double jeopardy when countries face fiscal constraints, but their debt servicing doesn't go away. We didn't see major breakthrough in debt relief. There's no debt relief. There's some debt suspension initiative from the G20, but overall, countries are struggling with high levels of debt, especially smaller economies, Maldives, Bhutan, Sri Lanka, and larger economies as well. India has a very high level of debt, but unlike Maldives or Sri Lanka, most of the debt are external debt, and that has additional challenges that I'll come back in a minute. And also, one of the challenges that we see is that in case of China, there are a lot of uncertainties emerging, whether there'll be whether China would be able to maintain the momentum, growth momentum that it managed to achieve in 2021. There are some headwinds in China, especially in the real estate sector, and also the trajectory of the trade tension between China and the US and how that would pan out. That would also be a major factor for the regional growth prospects. West Asia's story is similar to South Asia's. We see overall economic sentiments improved during the second half of 2021. Vaccination progressed fairly well, and that is probably the plus side, and that stimulated domestic demand. So a lot of demand came from the domestic side, as opposed to in East Asia. External demand played a very important role. So we expect a recovery to continue in 2022. And now, since we wrote the report, we saw some changes in terms of the oil prices, which is very critical for the region. Positive or sharp increases in oil price would probably add more sort of wind to the sail of recovery for the region. And we see that, but overall, the larger economies like Saudi Arabia and UAE, they all grew by about over almost 6% in 2021, but all this growth would moderate to about 4.5-5% in 2022. So the story behind that recovery that we had in 2021 was a recovery supported by fiscal and monetary stimulus. In the report that we wrote, we focused on the monetary policy stimulus, which was unprecedented in scale and scope. globally, $10 trillion of what we call asset purchases by the central banks allowed massive, sort of injection of liquidity to the global economy. Mostly the Fed in the US and also ECB, European Central Bank, and Bank of Japan and Bank of England, they together, they expanded their balance sheet by $10 trillion. What does it mean? So they bought debt from either sovereign debt in the domestic market and also corporate debt in some cases, so that the government would have more liquidity to spend on. So it supported the monetary policy side, supported the fiscal side by those asset purchases. And also it helped corporations and businesses to have more liquidity so that they could invest and they could support growth. And join the group was also, we saw that 27 developing countries, for the first time, they also joined this or implemented this strategy of asset purchases. There's another name for it. I'm sure many of you are familiar. It's called QE, quantitative easing. So this time we are calling it APPs because it's broader than QEs that we had in 2008-9. First used in the US in 2008-9, but before that also in the 90s, Japan, Bank of Japan also did QE of some kind. But one concern that we have, and we marked it in our report, is basically the effect of these APPs. They were mostly intended to stabilize the markets, to make sure markets remain calm. There's no panic sell. There's no last thing we wanted in 2020 was a financial crisis. So to make sure the financial system works smoothly, this APPs played a very important role. But they also had a longer term goal to stimulate investment and stimulate growth. On that front, the evidence is mixed. We don't see much evidence that actually APPs helped to stimulate growth significantly. They lowered the cost of borrowing for governments and businesses. Still, the interest rates are very low in most countries, but that didn't mean businesses went and borrowed money and kept expanding. And you can't blame the businesses because there was no demand at that time. The demand was very uncertain, so no businesses were spending. So what we saw in many cases, especially in the US, corporations, large corporations were using that money, extra liquidity they had, to buy back their own stocks. Stock buyback became very popular. I think about over almost $200 billion of stock buyback happened in the US, almost $200 billion. And that was basically what we saw, that massive increase in stock prices, both through the buybacks, but beyond the buybacks, through the APPs, because excess liquidity in the system meant that liquidity chased equities and real estate prices. And we saw massive increases in all the major indices, not only in the US, but also in Europe and also in East Asia. So the pandemic story of the rich getting richer to some extent. And if you look at the US case, top 1% gained on average $3.5 million. The net wealth gain was $3.5 million. But if you look at the bottom part of the distribution, the gain was about only $5,300 per person. So there's a very disproportionate effect depending on. So the reasoning is very simple. Those who are wealthy, they hold stocks and bonds and ETFs and all kind of financial assets. And when the prices of financial assets go up, they benefit a lot more. But the poor households don't have financial assets except for cash, and cash doesn't go up. In fact, if anything, the value of cash goes down if there's inflation. And other than some of the middle class households, of course, if that real estate, they gained a little bit. But overall, this economic stimulus benefited the rich more than it benefited the poor. And that is a challenge that the policymakers are coming to terms with. And there are discussions in Fed and in the ECB, how do we fix that problem? And as I said, the effect on growth, long-term growth, still very muted because investment didn't pick up as much as it should have picked up. And this is the graph that shows that major indices in the US, S&P 500 or NASDAQ, they're all spiked since the pandemic. And this is sort of, again, a contradiction. We're supposed to be in a global financial crisis, a global economic crisis, but there's a decoupling of finance and the real economy. Finance did very well. If you look at the hedge funds in the US, they did tremendously well in 2021. While the rest of the economy was not doing that good, but overall economic benefits accrued mostly to the ultra rich and the wealthy households. So, and coupled with that, a mirror image of that is that, if you look at I mentioned that in a region, some of the countries in Asia Pacific region having high debt. And that story is also linked to the APP, because since the global financial crisis in 2008-9, global liquidity, there was abundance of global liquidity. And interest rates in the West was at very low at that time. In advanced economies, it was close to zero, with zero lower bound. So money at the time flew out of the advanced economies and came to the developing countries because you could get higher yield, higher return on those investments. So one of the things that we saw that many of the developing countries in the last 10 years or so, since the global financial crisis, they went to the international capital market and issued bonds, euro bonds or sovereign bonds. And so the external debt of those countries, in many developing countries and low and middle income countries, increased by over 101% in the last decade, between 2010 and 2019. So, but if you look at the previous decade, between 2001 and 2010, the net debt of those countries, external debt of those countries, will decline by 7%. So you can see that all of a sudden explosion of public debt, public external debt of these countries. And to make things worse, this time the debt is mostly owed to the private creditors. And there's a difference, because a developing country can borrow from a multilateral organization like the World Bank or an Asian Development Bank or any of these specialized banks, or they can borrow from the IMF if there's a balance of payment crisis, or they can borrow bilaterally from a bilateral donor or development partner. But this time, because of the liquidity in the financial sector, almost all the borrowings happened through the private sector channel. The creditors are private creditors. And as we saw in the G20 debt relief initiative, private creditors didn't want to agree to any kind of debt suspension. They basically they didn't accept it. And if you look at the debt to the private creditors, it increased by 264% between 2010 and 2019. So exposure to the private creditors almost increased threefold. And that has a lot of consequences, because these are high cost borrowing, high cost debt, because on average, the interest rates on those debts are about 7 or 8% compared to debt owed to the World Bank or other multilateral organizations would be about 1% or 2%, much lower cost. So we see a massive increase in the volume of debt owed to the private creditors, and which are much costlier. And those creditors also are much more, volatile and unpredictable. So there's a more likelihood that some of them would want to. We saw some countries facing debt crisis in 2021, and I think many of the countries are on the verge of a debt distress or debt crisis, partly because these debt are very expensive debt. So that we call for greater international cooperation and for restructuring the debt and offering some kind of debt relief, but we haven't seen enough progress in that front. And so overall, we see that cost of public debt is a major constraint on fiscal space in many developing countries, because as you understand and as you know that debt is the payment is fixed unless there's a debt suspension or debt relief. So rain or shine, countries will have to service their debt, or they default, and default has other consequences. So, and that really makes it very challenging for many of these countries. And on top of that, we are seeing inflationary pressures in many of the countries, not only in the US or US inflation report came out, highest inflation in 40 years' time. And many other countries, including developing countries, are seeing rising inflation. And that creates another level of constraint for countries to have stimulus going forward. Because instead of expanding the fiscal or monetary stimulus, there's pressure right now to cut back spending to tame inflation. And that's the challenge, because when you fight inflation, you can also kill growth, because a sudden contraction in spending by the public sector, by the government, can lead an economy to a recession. So many of these countries are walking a tightrope, and that would not be very easy going forward, because in 2020, they had some fiscal space that has already been exhausted. And now, if they want to spend more, they will hit a wall, because A, they have high debt, they have to service their debt, and B, they have inflation, and more spending might increase the inflation even further. So that kind of a policy challenge is confronting many of these developing countries, and their more support from the international side will be very critical to basically to tide over this challenging situation for many of those countries. And so there needs to be much more policy support, especially for job creation. And what we see that, as I mentioned in an earlier slide, job growth in many developing countries have stalled, and we need to have targeted policies to stimulate job growth, because we may be in a situation where it's called jobless recovery for many of the countries, or a recovery but not enough jobs being created with economic growth. And also we need to expand social protection programs in many developing countries, because even if the pandemic is contained, many of them would not be able to come back to the labor market quickly. So there needs to be support for women who want to come back, but child care and other expenses are very high. So they need support or social protection of some kind of transfer to enable them to rejoin the labor force. So in the last slide, what I would highlight is that we are at a critical juncture. The road would become bumpier if, especially, what the central banks in the developed countries would do, and many of the developing countries are at the receiving end. If the Fed, U.S. Federal Reserve Board, if they start raising interest rates, there's an indication, clear policy indication, that they will unwind or they will stop asset purchases starting from March. And probably there'll be a first rate increase in 3 years' time in this March. If the rate increases are too quick, that would have huge impact on fiscal financial stability globally, because money would flow back. All of a sudden, we'll see capital outflows. Many of you may remember there was a taper tantrum in 2013 when Fed just announced some kind of stopping of the QE at that time. Many of the Asian countries saw a massive disruption in the financial market. And 2016-17, we saw similar thing, massive outflow of capital from developing countries back to the developed countries, because Fed started raising rates. So I think that is the critical challenge for many countries right now, especially countries that have open capital accounts. Many of the countries in the region, Asia Pacific region, have open capital account, so they won't be able to stem the capital outflows, and that would increase the cost of capital both domestically, and if they want to borrow internationally, they'll also face higher interest rates, and that would overall impact their growth prospects. And also, monetary policy side itself is important, but there needs to be more complementary policies to support overall monetary policy stances in developing countries. For example, there needs to be much more careful communication, both between central banks in developed countries and developing countries, but also between central banks and other parts of the economy in each of those countries. We need better macroprudential policies, because even if there are capital outflows pressures, some of the macroprudential tools can help. Capital account management can help to stem the outflows, because it will be very critical to make sure that we don't have massive outflow of capital as we saw during the global financial crisis. Greening of the APPs, if central banks want to hold on to the assets that they purchased, it can create some kind of incentive mechanisms to make sure those assets that they're holding support the climate change agenda, because that's a way to incentivize investments in climate action. And final point that we make in the report is that at the same time, we have to have meaningful reforms on the fiscal side and taxation policies, because monetary policy can only support that much. We saw monetary policy reaching its limits in 2020, 2021. Now we have to have more support on the fiscal side, and that might be possible if inflation comes down, and also we are able to reform the fiscal and taxation policies in many of the countries in the region and beyond. I'll stop here, and then we'll take it from there. Thank you. All right. Back.
Thank you, Dr. Hamid. Yes.
Yeah.
So I'll open this floor now for questions. You may raise your hands, or if you want, you can also write down the questions in the chat, and then we will relay it. To kick things off, I have a question from the Philippines. The question is that, especially in Southeast Asia, we saw that the pandemic showed a great change in consumer behavior, where people moved to e-commerce rapidly. How might this change the landscape of the economies in Southeast Asia, or would this have a lasting impact on the economic growth of the region? Yeah, so
I think I'll go beyond the report. We don't discuss that in the report, but let me take the liberty here. And I think pandemic, if you look at the history of pandemics, we have 2,000 years of history of pandemic. The Justinian's plague in the 5th and 6th century, and then we have the Black Death in the 12th, 13th century in Europe. Every pandemic, or even the 1918 pandemic, pandemics have a characteristic of fundamentally altering human behavior. And this time is not different, because what we are seeing is that people's behavior is changing substantively in terms of how they're, consume what they consume. And we are definitely becoming more digital. And that is the trend right now. So the simple projection that we can make is that would see definitely more e-commerce, more digital space, but I'll go beyond that. We'll see more virtual reality, more augmented reality. So people would have vacations without physically going to a country. They would have virtual reality vacations. Games, online gaming demand would go up. So a lot of changes would happen on the technology front, because it would demand more and more goods and services that are driven and developed by new technologies. And I think that's the trend. The pandemic accelerated that trend. It was already there. So we are having this meeting via Zoom, and that has become the norm. And most of the meetings will happen. I think official or business travels will decline significantly. Tourism that we knew in the past will not come back, to that extent. So all the shifts will take. Plus, at the same time, we don't cover that in the report. If you look at what is happening in the crypto world, cryptocurrencies globally, there's a huge bubble. I call it crypto bubble. That's also happened during the pandemic. At the time when the pandemic was announced in March of 2020, total crypto market capitalization of Bitcoins and all the other currencies together was 189 billion in March of 2020. By November of 2021, the market cap of Bitcoins and stable coins and Ethereum and everything else combined reached $2.8 trillion. So over a 15-month period, you had a 15-fold increase almost. So that's a bubble of, and that bubble is also chasing other kinds of assets. That's also digital assets known as NFTs. The people are buying NFTs for obscene amount of money, also using crypto money. So short answer of that is that yes, this will definitely alter, but the countries that have more digital assets and digital skills will do better. Is understandably, because and I think that would also create more digital divides. Some of the countries were already had a lot of digital capacities to create games, create digital assets, and they did relatively well. And this divide would probably widen going forward. And this is also linked to the to educational inequality, because what happened, pandemic affected access to education disproportionately. The poorer households who had no internet connection, they fell behind compared to households that had access to internet. So children 10 years from now will see some of the pandemic generation children, they'll have very different learning abilities. And so going forward, we'll see that kind of inequality even widening. So picture is not very bright, but those who were ahead in the game, they'll get further ahead.
Thanks. And I think that this ties in with the next question. It comes from Bangladesh. Now you mentioned one of the policies that needs to be addressed is more job creation. Now the question is that in Southeast Asia and South Asia especially, the economies rely heavily on the labor movement and a migration for labor migration, and the pandemic has kind of inhibited this. So what can be done in terms of policy by policymakers to thrust this forward? It's the question.
I think the labor mobility, both internal mobility and also labor migration, international labor migration, I think there needs to be a far more coordinated approach to vaccination. That is critical because we have to restore confidence, because employers and employees would both need to feel they are safe. And I think unequal access to vaccine has been a huge impediment to labor market participation, because many of the workers especially those who are contact intensive workers, those who are directly dealing with customers, and they have not been able to get vaccines, they have not been able to return to work. And so many of them, like in India, for example, we have anecdotal stories. Those who left the cities at the beginning of the pandemic, they have not been able to come back because they're still waiting to get vaccine or get the access to vaccination so that they can come back to work. So obviously, vaccination would play a very important role, but that would be at best necessary condition. We sort of alluded to the issues of labor market policies. So we need more active labor market policies to support reintegration of the workforce, because what is it, active labor market policies in terms of support that they need, whether it's unemployment benefits or other kind of benefits to bridge over this period. Support for working women would be very important, because many women cannot come back because if everyone is unemployed and childcare costs, who takes care of your children? So and you can't go back because you have to take care of your children at home. So I think that's a challenge that we have to address. Other kind of retraining programs can be very important. Reskilling people, because skills, some of the skills that they had before, those jobs, as one of the questions that we had early on, that some of this East Asian, Southeast Asian economies, digital space, they're moving to the digital space. So we need different skill sets for those to do business in the digital space. So retraining, reskilling of the workforce would be very important. So we need massive investments in labor markets, sort of policies to support labor force participation rates. So far, all the money went to basically fighting the pandemic. Now we need more money, more resources to support full recovery, inclusive recovery.
Thank you. And the next question is from Malaysia, which is, can asset purchase programs be tailored to benefit less wealthy people, and should they be also tailored as part of an effort to redress inequalities?
Can you say it again?
Can asset purchase programs be tailored to benefit less wealthy people, and should they be so tailored as part of an effort to redress inequalities?
Very good question. I love that question, to be very honest. Yes, it can be, but it not be through the asset purchases. If you think about, you had massive gains through asset purchases because APPs definitely inflated asset prices. Asset, both real estates and stocks and bonds and other kind of financial assets. So this is where the fiscal policy comes in. There could be a special tax to basically take away some of the gains, abnormal gains that some of the investors had, and that could be redistributed to make society more equal society, egalitarian society, or to fund the previous issue that I raised, to retrain the workforce. So ultimately, what we need to have an inclusive recovery is not just to bring back the workers to the workforce, but also to make them more productive. So more investment in the labor force will be very important. So there's no mechanism just to target asset purchases, because asset purchases by the central bank, basically those who hold those assets, they will benefit, because the whole objective is to support the prices of those assets. And because of that, prices go up. But if we don't tax them, then obviously they get all the benefits. And many countries, they don't have enough progressive taxation, and that's a challenge. If the taxes could be progressive, sufficiently progressive, then we would have some of the transfers money back to the less wealthy households.
Yeah. Now, if anyone would like to, I think we'd like to see someone up on camera, give the chance for a reporter to be up on camera. So if anyone wants to ask a question directly, you can raise your hands. And while you do that, I will move on to the next question. And it comes anonymously, which is quite a bit, because it's a bit sensitive. Now, do you see Asian economies shift their reliance on Western financial institutions and move towards Eastern financial facilities within the trends of these couple of years?
Yeah, I think this is not a sensitive question. It's a question of global imbalances. The reason that West, or reason that dollar is the dominant currency globally, is not an accident. It's not because the US is the largest military power in the world. It's simply because US has been consuming more than it's making. That means US is running large deficits year after year. And that is helping the rest of the world, to be very honest, because without US running the large deficits, we would not have enough surpluses in the world, and the supply of dollars come from, if you look at the balance, the way that it works is that just because US runs the deficits, the rest of the world has US claims on US assets. And when you're holding the US treasuries, and that is a loan to the US government, indirectly, so US is consuming on credit. So rest of the world is selling goods and services to the US on credit. So it's a mutual dependence. If other countries would come forward and are willing to run that scale of deficits, and are willing to tell the world, like, look, we're going to spend more than we earn, then that currency would replace the dollar as the reserve currency. We expected that to happen with the euro, but it hasn't happened, because US is a very consumerist society. So they have been consuming way more than they've been producing for the last 30 or 40 years. And that is the basis for, in terms of economic fundamentals, that's the reason that US is a dominant economy, because they are able to supply all the dollars to the rest of the world. And we're all holding US assets. And in a way, it is a mutual dependence, because as we hold the US dollars or US treasuries, we don't want US to go under, because if the US goes under, the value of the treasuries, value of the assets that we're holding also goes under. So in a way, you would want the US to remain successful and grow very fast. And how does US do that? Because US has the advantage of being the most productive economy in the world. All the innovation that takes place in the US, that helps the US economy, even though they consume more than they make. But the gap is partly offset by very large productivity growth of the US economy. The short answer, I don't see that changing very quickly, because we're all very dependent on US dollar and US consumption patterns. If suddenly the US goes into a great recession and US households cut back on spending, it will affect the rest of the world far worse than it would affect the US, because the export to the US would also suffer significantly. So we have to see the adjustment. So it will be gradual adjustment over many years, but we won't see. I don't see that happening, very quickly.
All right, I'll move to the final questions now. One before the final question, there's one that asks, in the midst of this pandemic, we are now expecting, or we are talking about a potential war in Europe with the Russia and Ukraine conflict. So how much of a burden would this add on to the projections that you have made?
We didn't, of course, this when we finalize our numbers, there's no conflict in Europe or anticipated conflict. We didn't expect that. The way our forecast works is that our forecast takes into account some of the baseline prices, like oil price. When we wrote the report, our forecast oil price was between $65 and $70, but now it's $93, $94. So obviously there are winners and losers in that scenario. So without going to geopolitics, some of the countries that are large oil exporters will benefit from this tension environment, the environment of near conflict. And some countries would also lose out, those who are dependent on oil imports significantly. So overall, we don't expect this to significantly alter this forecast, short-term forecast. It will just have some redistribution effect. Some of the countries would, if you look at the global average, we'll stick to our global average of about 4% growth in 2020, 2022, and that is our baseline forecast. That won't change if other dynamics change. But some of the countries would grow faster than expected, and other countries would go slower than expected.
You talked about the crypto bubble. There's a question: Will the crypto bubble burst?
The history of bubbles, every bubble that came at some point burst. But the problem with that story is that you don't know when it will burst. If we knew, then of course we'd all be very, very, very rich. Those who can predict that. So yes, it will definitely burst at some point, but we don't know exactly when, because already we saw a massive contraction in the value of crypto since November of last year. I gave the number 2.84 trillion. That was in November of 2021. And now the latest number, if I probably a week ago I saw, it is about 1.6 trillion. So 2.84 trillion to 1.6 trillion. So already you see a massive reduction in the value of cryptos. And partly also within the crypto world, there are a lot of competition. There are about now 11,000 different cryptocurrencies. There are some dominant ones, but there are also many entrants. So they're all competing with each other for a market share. So yes, that will affect the value of crypto. And I think if it's not fully deflated, we are definitely seeing a downward trend in the crypto world. So.
And for the, if anyone else does not have any more questions. No, the final one I have is, are you optimistic or pessimistic about international debt relief for the countries that are desperate?
That's a very difficult question to. I mean, I would not take any position of optimism or pessimism, but I can say what is desirable. Desirable. I think it is. We have a scenario if without restructuring of debt, I would not even use the term debt relief, but we need to restructure some of the debt, because debt level for many of the countries in the region, but also beyond the region, in Africa and also in Latin America, they're not sustainable level of debt. And there's a debt overhang. And that would drag growth down, because if we don't restructure the debt, because what happens is that when your debt servicing becomes too high related to your income or related to your government revenue, then most of the money goes into servicing your debt, and less money is available to stimulate growth. That means in the future, there'll be even less capacity to service your debt. So it's in the interest of all countries to come together and have some kind of debt restructuring. I'll give two anecdotes. In 1930s, between the two world wars, there's a famous economist, John Maynard Keynes. Many of you know him. He was arguing, to ad nauseum for debt relief, because post-war World War I, many of the countries in Europe had a huge amount of debt owed to the US, including England at that time. And the US renegotiated relief for them in 1935. There's a conference in London, and that basically a lot of people say that if London conference succeeded, and if there was a meaningful debt relief, we could probably avoid World War II. That's a counterfactual. We could never prove one or the other, but that is the story that we have, is that debt relief in 1935, the major creditor country didn't agree. And now it's even harder because most of the creditors are private creditors. They have very little incentive to offer debt relief. Fast forward to 2000, 2002, we had the HIPC, heavily indebted poor country, and MDRI, multilateral debt relief initiative. We gave, many of the countries in Africa, I think altogether amongst few countries from Latin America, received debt relief. I think 46 or 47 countries. But that debt relief also didn't work. We gave the debt relief, and within few years, they again went up debt significantly. The debt went up, partly because that with the debt relief, the new fiscal space that was created, that was not invested. That money was not invested in improving productivity and productive capacity. So if countries don't just get debt relief, but nothing changes on the policy side, they don't invest in human capital, they don't invest in infrastructure, they don't invest in more fiscal efficient spending of the fiscal revenue, then 10, 15 years time, you would have the same debt crisis again. So this time, if there is a debt relief, it has to be also contingent on some of the other priorities of our time. Two priorities would be very important. One is that fighting climate change, both on adaptation, especially in low-income countries, adaptation is very, very critical. Also, in middle-income countries and countries that are able to do so on mitigation side. And second issue would be also a debt relief to address issues of inequality. So countries will have to take it seriously that we use the debt relief money to make productive investments and reduce inequality. And that would make debt relief it's self-sustainable. Otherwise, we would just have a piecemeal solution, but it will not solve the longer-term problem.
Thank you so much. We have one final question, which is, with rising digitalization, there is a gig economy in place. This has added to the structural inequalities and limited socioeconomic mobility, as some of these workers do not possess social security net and pay protection during events like a pandemic. What can the solution be for this?
Again, the solution is in having the right taxation policies. We have to find a way to, if you're creating digital wealth, you're in the gig economy, make sure governments are able to collect taxes, and or create a program where the social security contributions are made by those people who are in the gig economy, and there are matching contributions from the government, like as we do in the private sector. Sometimes in some countries you have private social security or contributions coming from both self-employed and the government. So there has to be an incentive mechanism for them to contribute to their own future safety. So if we cannot say that, okay, look, we are a gig economy, we don't want to contribute anything, we don't want to pay taxes, we just want to live on this gig economy, but when economy crashes, then you want bailout. That doesn't work. In that case, the government would have to say, look, we have to pay taxes and you have to pay and make social security contributions. And I think some of the countries have done well in that direction.
Thank you so much. I think I don't have any more questions. So we will wrap this, but thank you for the presentation and the insights and the set questions for the answers for the questions and the reporters sent in. I think they will have a lot to go on and report on after this session. Thank you, Dr. Hamid, and also thank you to Francine and Sharon and Helen from the United Nations Global Communications Department, who was very kind enough to organize this session for us. We hope that with this, we are starting a new journey, a new collaborative journey with the United Nations Communications Department and other branches.